Okay, guys, welcome. Today we're going to talk about loan payments, credit cards, and mortgages. Okay, so first we're going to start off with some loan basics. So for any loan that you have, the principal is usually the term that's given to the amount of money that's owed at any particular time. Then, of course, the whole concept why people offer loans is so that they can make interest. And of course, interest is charged on the loan principal. Now, in order to pay off a loan, you must gradually pay down the principal. And the last term that we'll have here is what's called the loan term, which is the time you have to pay back the loan in full. So, for example, a lot of car loan terms are 5 years, whereas things like mortgages are usually more like 30 years. All right. Now, the first type of loan that we're going to talk about is what's called an installment loan. Now, a loan that you pay off with equal regular payments is the type of loan that we refer to as an installment loan, right? So most of the time you can think of like a car payment or a mortgage payment as an example of an installment loan because you're paying the same amount generally each time. And of course, the interest that's due each month will gradually decrease over time, whereas the amount that you pay towards the principal will gradually increase over time, right? So in the beginning of the loan term, you're paying almost everything towards the interest, and by the end, you're paying almost everything towards the principal. All right. Now, the loan payment formula for installment loans, or what's sometimes called the present value formula, because the large amount of money is specified now in the present time, formula is as follows, right? So you have PMT, which is your regular payment amount. And of course, we would take our principal times our R over N, and then we're going to divide that by 1 minus parenthesis 1 plus R over N, and all of this to the minus NT. So it's sort of similar to the future value formula, or the like the savings plan formula, but it's slightly different, right? So of course, mostly everything that we have here is the same, except we have PMT for the regular payment amount. All right, so let's take a look at an example. So suppose you have student loans totaling $7,500 when you graduate from college, and the interest rate is 9% APR, and the loan term is 10 years. Now, what are your monthly payments? How much will you pay over the lifetime of the loan, and what is the total interest you will pay on the loan? All right, so let's look at this. So of course, since we're paying off something, we're going to use our loan payment formula, right? So P times R over N over 1 minus parenthesis 1 plus R over N to the minus NT. Of course, now here we'll just fill in everything that we know. So P we know is 7,500. Our R is 0.09. And of course, it's monthly payments, so N is 12. And then we're dividing this by 1 minus 1 plus 0.09 over 12. And then raising this expression in parentheses to the minus N, so 12 times 10. And again, if you're going to enter this in the calculator, make sure that that exponent in the bottom is in parentheses, and also make sure that you use the negative sign and not the minus sign in your calculator, or else that might not come out either. All right, so if we enter this in the calculator, we're doing 7,500 times 0.09 divided by 12, and then we're dividing that entire thing by parenthesis 1 minus parenthesis 1 plus 0.09 divided by 12, close parenthesis, then we need to exponent, so caret button, another set of parentheses for minus 12 times 10, close that exponent parentheses, and then close the denominator parentheses. And if we do that, we find that our payment is going to be about $95.01. So this is our monthly payment. So that's the first answer that we have, right? So the first thing we wanted to figure out was what are the monthly payments, and then there they are. Now, how much will you pay over the lifetime of the loan is different, right? You're not paying $7,500 because you're also paying interest. So I need to take my monthly payment, 9501, multiply that by 12, and then by 10, right? I need to take my monthly payment times the number of months per year, and then multiply that by the number of years. Right? And then this will give us how much that we're paying over the lifetime of the loan. So now if we do this, 95.01 times 12 times 10, that will give us $11,401.20. So that's how much you're paying over the lifetime of the loan. Right, and of course the last part of this is, well, how much interest did you pay on the loan? Well, the interest is how much you paid minus the original loan. All right, so of course we paid $11,401.20 over the lifetime of the loan, and this was for a $7,500 loan. So now if we subtract here, so if I do $11,401.20 and I subtract 7,500, that's going to give me $3,901.20. So this amount went towards interest, right? Which is a fairly large percentage, right? Your original loan was $7,500, and this is over half of that, right? So you've paid over more than half of the original loan in interest, right? Okay. Now, the next example, we're sort of continuing off example one. We want to calculate the interest portions of your payments that go to the principal and to interest during the first 3 months. Now, I think I want to skip that one because I'm not going to be too concerned with this. But the idea here, if you're really interested, you can sort of check this out on your own. But the idea is that in the beginning, most of your payment is toward interest. Right, and here's why. I'll show maybe one example of this. So we have $7,500 as our original principal. And we're being charged 9% interest, right? Now, for the first month, I need to take 0.09 divided by 12 as my interest rate. So in the first month, I have 7,500 times 1 plus 0.09 over 12. And then that will give me how much interest I would accumulate in the first month, right? So then this would give me, let's see, 7,500 times 1 plus 0.09 divided by 12. And that will give us that this will now go up to 75.5625. So we've accumulated $56.25 in interest. But your monthly payment that we saw in the last example was $95.01. So what's the percentage of the monthly payment that's going towards interest? Well, 56.25 is going towards interest out of 95.01. And if you find this as a percentage, if we do 56.25 divided by 95.01 and multiply that by 100, we get that this is 59.20%. So over half of your payment is going towards interest in the first month, right? And of course, you could do this for the next couple months, and you would find out that your interest is going to slightly go down, because once you make that $95.01 payment, then what's happening is that you're going to have less interest to work with, so more of the payment over time will be going towards the principal. Okay, so let's look at another example. Now we need a $6,000 loan to buy a used car. All right, now your bank offers a 3-year loan at 8%, a 4-year loan at 9%, and a 5-year loan at 10%. Now we're going to calculate the monthly payments and look at the total interest over the loan term with each option. Okay, so again, we're using the same formula. We're using PMT is equal to P times R over N over 1 minus 1 plus R over N to the minus NT. All right, so we can do this fairly quickly because we're just going to be changing a couple of the numbers, right? So for the 3-year, 8%, our formula is going to look like this. We're going to have 6,000 times 0.08 over 12, right? Monthly payments still. And then 1 minus 1 plus 0.08 over 12 to the minus 12 times 3. Right? Now for the 4-year, the only thing that's going to change, well, the only two things that are going to change are going to be our interest rate. So this is now 0.09 over 12. This is 1 minus 1 plus 0.09 over 12. And this is to the minus 12 times 4 now. All right, and then finally for the 5th year, 5-year plan, right, you're going to have 6,000 times 0.10 over 12 divided by 1 minus 1 plus 0.10 over 12 to the minus 12 times 5. All right, so now we just have to calculate what our monthly payment's going to be in each scenario. All right, so if we enter the first one in, we got 6,000 times a 0.08 divided by 12. And then we're dividing that by parenthesis 1 minus parenthesis 1 plus 0.08 divided by 12. And then we're raising that to the parenthesis minus 12 times 3. And close that one, close the entire bottom. And it looks like this monthly payment is going to be 188.02. Okay. Now the next one, and a good thing that you can sort of get in the habit of is that if you're going to do similar calculations, what you can do is go back to the previous entry you have in your calculator and just sort of edit it, right? So that's what I'm doing now. So I'm changing my 0.08s to 0.09s. I'm changing my 3 to a 4. And it looks like that's going to give us monthly payments of 149. Wait a minute, is this right? This doesn't look right. No, I guess that's fine, right? Yeah, so 149.31, right? And then same thing for the last one. We go through and change my 4 to a 5 and change my 0.09 to a 0.10. We're going to get that this monthly payment is 127.48. Okay, so now those are our monthly payments for each scenario, right? So there's monthly payments. Now we want to figure out, well, how much are we paying over the entire life of the loan for each of these, right? That was the second part. So total paid would be take your monthly payment, so 188.02 times 12, and this was for 3 years, right? And of course, this one would be 149.31 times 12 for 4 years. And this one would be 127.48 times 12 for 5 years. And that will give us the total paid for each of these. Okay, so the first one, 188.02 times 12 times 3 will give me a 6,768.72. For the next one, 149.31 times 12 times 4 will give us a $7,166.88. Right, and then finally the last one, 127.48 times 12 times 5 will give us a $7,648.80. All right, so now we can talk about the pros and cons of each of these types of payments, right? Now, if you take the first option, you're obviously paying a smaller interest rate, so you're gonna owe less money in the long run, right? Now, your monthly payment is more than the other options, right? Your monthly payment is 188.02, but in the long run, since your original loan was $6,000, you're paying less than $1,000 of interest, right? You're only paying $768 worth of interest. Now, of course, if you spread the loan out over a longer period, your monthly payments are going to be lower, but that gives more time for interest to accumulate, and you're ultimately going to pay over $1,000 of interest in this scenario. All right, and then of course, in the last one, you have the cheapest monthly payment, $127.48, but of course, this one will accumulate the most interest because you're spreading it out over the longest time period. Right. So these are some of the pros and cons that you will actually weigh when you go to pay off a loan. And you can consider these in their own right, especially when you go to do something like purchase a car. This is one of the things that they'll use to negotiate with you to figure out how much your monthly payment would be. Okay, so next we're going to talk about credit cards. Now, credit card loans are different from most installment loans because you don't have to pay off your balance in any set period of time. What you are required to do is to just make a minimum monthly payment, right? And generally that minimum monthly payment will cover some of or all of the interest, but very little principal. And in fact, that's what the credit card companies want, because most credit card companies have a very high interest rate compared to other types of loans. So if you don't pay off your loan, you're ultimately going to owe the credit card company more money. So they, in fact, want you to make that minimum monthly payment rather than to pay off more, because they make more money if you only pay the minimum monthly payment. Right? Now, you have to be careful of these very high interest rates on credit cards, because if you do miss payments, it's very easy to get into financial trouble. Right? So for example, let's suppose that we have a credit card balance of $2,300 with an annual interest rate of 21%. Now we decide to pay off our balance over 1 year. Now we want to know how much will we need to pay each month and assume that we make no further purchases. Okay, so this is the same formula as before. I need my payment is equal to my principal times R over N, and then all of this over 1 minus 1 plus R over N to the minus NT. So now in this case, my principal is $2,300. My interest rate is 21%, which by the way is not out of the question for a credit card interest rate, right? Most of them are very high. And then we're doing monthly payments, so over 12. And then we have a 1 minus 1 plus R, so 0.21 over 12 to the minus 12, and this is 1 year, so just 12 times 1 here. Now, if we throw this into the calculator, we have 2,300 times a 0.21 divided by 12, and then we're dividing that by parenthesis 1 minus parenthesis 1 plus 0.21 divided by 12. And we'll close that and raise that to the minus 12 times 1. And it looks like we're going to ultimately pay $214.16 per month. Okay, so that's how much you're paying each month. Now, just as a quick calculation here, let's just find out how much of that would actually be interest. So we're making $214.16 payments for 1 year each month. So I just need to take this number, this 214.16, and multiply it by 12, and you're paying $2,569.92, right? So even in the short amount of time, and you're continually paying this balance off, you're still ending up paying almost $300 in interest in just a year's time, right? So with these large interest rates, you're going to be paying quite a bit towards interest if you accumulate a large balance like this. Okay. Now let's look at another example that sort of shows the dangers of credit cards. Now, Paul has gotten into credit card trouble. He has a balance of $9,500 and he just lost his job. Now, his credit card company charges an interest of APR and an APR rate of 21%, and it's compounded daily. Now, suppose that the credit card company will allow him to suspend his payments until he finds his new job, but is going to continue to charge interest. Now, if it takes him a year to find a new job, how much will he owe when he starts his new job? Well, this is just a simple interest problem. Well, not a simple interest, it's a compound interest problem, right? So we need to do A is equal to P times 1 plus R over N to the N times T. So in this case, our principal is 9,500, and we have 1 plus, now our interest rate is 0.21 over 12 to the 12, and we're assuming it's taking him a year to find his new job. So 12 times 1 are just 12. Okay, and this will get us the new balance after 1 year, right? Because we're still accumulating interest. So now if we plug this in, you have 9,500 times 1 plus 0.21 divided by 12 to the 12. Now this is going to jump up to $11,698.67. Right? So in just a year amount of time, right, by not making these payments anymore, because he got into this trouble, he now owes $2,000 more than the original amount, right? So this is one of the ways that you can get into trouble with credit cards. Okay, now the next type of loan payment that we're going to talk about is mortgages. Now, mortgages are loans that are designed to help you buy a home, because if you look at the prices of homes, most of them are not in the price range where most people have that type of money lying around, right? Now, interest rates for mortgages are usually lower because the home itself serves as collateral. And what I mean by that is that if you don't make payments, you know, the bank or the mortgage company could take your home as an asset, and then they would then have, you know, some sort of asset that they could then sell or you know, reuse if they wanted to. Now, most lenders usually require a down payment when you have a mortgage. That's usually about 10 to 20% of the purchase price. And of course, another thing that happens when you arrange for a mortgage is that lenders will also charge fees that are usually called closing costs at the time that you take out the loan. Right? Now, closing costs are comprised of two different things, right? So you have your direct fees that are, for example, fees for getting the home appraised and checking your credit history, and usually the lender charges a fixed amount for these. Now, there are also fees that are charged as points, where each point is 1% of the loan amount. Now, many lenders divide the points into two categories: an origination fee that is charged on all the loans, and then discount points that vary for loans with different rates, right? So for example, a lender might charge an origination fee of 1 point on all loans, then offer you a choice of interest rates depending on how many discount points you are willing to pay. Okay. Now, a home mortgage is an installment loan designed, again, specifically to finance a home. So a down payment is the amount of money that you have to pay up front in order to be given the mortgage. And then the closing costs you can think of as just our additional fees that you would have to pay. Now, the most simple type of home loan that you can attain is what's called a fixed rate mortgage. And in this case, the interest rate does not change over the life of the loan. So you can sort of lock in your interest rate. So there are pros and cons to doing this, because you could be avoiding interest rates going up, but then of course the con is that you could also avoid interest rates going down, right? So that's one of the things that you would have to weigh when going to purchase a mortgage. Okay, so let's do an example. Now you need a loan of $100,000 to buy your new home. I'm missing a zero here. Now the bank offers a choice of a 30-year loan at an APR of 5% or a 15-year loan at 4.5%. So we'll compare the monthly payments and the total loan cost under the two options. So we'll, just for the sake of simplicity, we'll assume that the closing costs are the same for both of these scenarios, so they don't affect the choice that we're going to make here. Now, regardless of which option that we use, we're still using our loan payment formula. So payment is equal to P times R over N to the 1 minus 1 plus R over N to the minus NT. So let's do the 30-year option first. This is usually the more common option. Okay, so let's go ahead and take a look. So in the 30-year loan option, principal is $100,000, that's not changing. And the interest rate is 5%, so 0.05 over 12. And all of this over 1 minus 1 plus R, 0.05 over 12. And then to the minus 12 times 30. So if we calculate this, we have 100,000. And again, in this example, they don't mention a down payment, so we'll assume that we've either already made, we'll just assume that we already made the down payment. I was going to say that they wouldn't require it, but I don't know of a scenario where you're not required to make a down payment. But anyway, so I'm going to divide that by 12. And again, when you're enclosing that exponent in the bottom, make sure that you're using the negative sign and not the minus sign, and make sure that that exponent gets its own set of parentheses. Okay, but anyway, so if we enter all this in, we find that our monthly payment would be $536.82. Okay, now let's look at the 15-year loan. Now, one thing that you should also be aware of is within that mortgage price, that is just to pay the mortgage, right? So one thing that's kind of hidden, and is especially a bummer if you live in the Northeast United States, is that you're also going to have to pay a fair amount of property tax with your mortgage payment. And in a lot of cases, if you live in a Northeastern United States state, then a lot of times that property tax will double or even more your mortgage payment, right? But anyway, so in the 15-year option, the interest rate is now 4.5%, so 0.045. So we can get away with just changing some of these values. 0.045 over 12, and now this is for 15 years, so minus 12 times 15. All right, oops, I cleared it out, so I'm gonna have to do it again anyway. So 100,000 times now 0.045 divided by 12. And then we're dividing that entire expression by 1 minus, parenthesis, 1 plus 0.045 divided by 12, close that, and then raise that to the minus 12 times 15. And here we'll get that our monthly payment is $764.99. Right? Now let's go ahead and we'll calculate how much we're paying over the life of the loan, right? So the total paid, of course, we'll need to multiply our monthly payment by 12 and then by the number of years. So in this case, by 30. So if we multiply 536.82 times 12 times 30, we're going to get that we're paying $193,255.20. So in this scenario, you're paying $93,000 worth of interest. Now in the other scenario, you have $764.99 times 12, but only times 15 in this case. So if I do $764.99 times 12 times 15, we're going to pay $137,698.20. So in this case, you're paying significantly less in interest, but you would have to fork over a fair bit amount over in regards to the monthly payment in regards to the other option, right? So again, pros and cons of both of these types of options. Okay, so let's look at another example. Now, Great Bank offers a $100,000 30-year 5% fixed rate loan with closing costs of $500 plus 1 point, and Big Bank offers a lower rate of 4.75% on a 30-year loan, but with closing costs of $1,000 and then plus 2 points. So we're going to evaluate the two options. So now, first of all, let's figure out what the closing costs are. So now for the Great Bank option, all right, the closing costs are $500 plus 1 point. Now 1 point, again, is 1% of the loan. And if we take 1% of 100,000, that's going to leave us with 1,000. So that means that our closing costs are $1,500, which now means that your total loan is $101,500. Okay, so let's figure out what the monthly payment is for this, right? So we want to do, again, same formula, so 101,500 times R, which in this case is 0.05, over N, so 12. And all of this over 1 minus 1 plus 0.05 over 12 to the minus 12 times 30. So if we do this, let's find out our monthly payment. So I got to do 101,500 times 0.05 divided by 12, all divided by 1 minus 1 plus 0.05 divided by 12, and then raise that to the parenthesis minus 12 times 30. Close everything up, and we're going to find out that our monthly payment is $544.87. All right, so that's for Great Bank. Now for Big Bank, we have closing costs of $1,000 and then plus 2 points. So of course, 2 points here would be $2,000. So this will bring our loan amount up to now $103,000. Okay, now the advantage here is that we do have a lower interest rate. So we're going to do 103,000. And here I believe the interest rate was 4.75. So we need a 0.0475 over 12. And we're going to divide this by 1 minus 1 plus 0.0475 over 12 to the minus 12 times 30. Okay, so we ought to figure out our monthly payment. So 103,000 times 0.0475 divided by 12. And then we're going to divide that by 1 minus 1 plus 0.0475 divided by 12. Close that, raise that to the minus 12 times 30. Close everything up, and we'll see that here that our monthly payment is $537.30. Right? So both of these options come out to be pretty much similar, even though our big bank costs left us with double the closing costs, right? In Great Bank, we had $1,500, and in Big Bank, we had $3,000. Now, this just goes to show you the power of the interest rate, right? So here the interest rate was 4.75%, and even though it was only a quarter of a percentage point less, it did actually bring down our monthly payment to lower than the other option, right? So that's the power of the percentage point there. Okay, so in the next example, we'll discuss an alternative strategy to the mortgage options. In example 6 is to take the 30-year loan at 5%, but to try and pay it off in 15 years by making larger payments, right? So first, let's figure out how much we have to pay each month, right? So this is the same formula. So we're going to find, So we're going to find that our payment, we still want to pay off, let's just say 100,000. And we won't include the closing costs, but we'll say 1,000, and then I want to do 0.05 over 12, all over 1 minus 1 plus r over n, 0.05 over 12. And now this time when I do to the minus n times t, I'm making my t 15 instead of 30. All right, so we're going to try and pay it off in 15 years and calculate what the monthly payment would have to be. So of course, 100,000 times 0.05 divided by 12, and then divide that by 1 minus, parenthesis 1 plus 0.05 divided by 12, close that, and then raise that to the minus 12 times 15. And we'll get that our monthly payment is now $790.79. Right? So of course, the idea here is that you're paying more money than each of the, okay, so we're going off of this option, right? So you're paying more money than the 30-year option, but the idea is that you're going to pay a lot less towards interest, right? So that's something that we've really already discussed before. And if you don't believe me, you can multiply it out for yourself and see that you're going to pay much less interest. Okay. Now, the last thing that we'll discuss here is what's called an adjustable rate mortgage. So this is sort of the other option. On the other hand of a fixed rate mortgage, you can get a mortgage for which the interest rate will change as rates on the market will change, right? So let's go ahead and let's take a look, and this will be the last example that we do for this section. Now, you have a choice between a 30-year fixed rate loan at 4% and an adjustable rate mortgage with a first-year rate of 3%. Now, if you neglect compounding and changes in principal, we'll estimate the monthly savings, we'll estimate the monthly savings with the adjustable rate mortgage during the first year on a $100,000 loan, right? So let's go ahead and let's just take a look at what our monthly payments would be for each of these. So 100,000 times R over N, so 0.04 over 12. This will be for the fixed rate. And then all of this divided by 1 minus 1 plus R, which is 0.04 over N, which is 12, and then to the minus 12. And we're just looking at the first year. So let's go ahead but we're still paying it off in 30 years, right? So I still need to do that. Okay, so then if we enter this in, we have 100,000 times a 0.04 divided by 12. Divided by 12. And then we're dividing that by a 1 minus, parenthesis 1 plus 0.04 divided by 12. Close that, and then raise that to the parenthesis minus 12 times 30. Close it all up. And it looks like our monthly payments in this case would be $477 Now for the adjustable rate mortgage, you're doing the same thing, except instead of 4%, it's 3%. Okay, so if I go back and I edit my previous one and change my 0.04s to 0.03s, we're going to find that our monthly payment is now $421.60, right? So of course, your monthly savings would be the difference of these two. So each month, if I do 477.42 and I subtract 421.60, I'm going to get that each month I'm saving $55.82. Right now, if the adjustable rate mortgage then rises to 5%, if you were to compute it for 5%, then what you would have, so let's see, and we would actually, in the third year, we would need to change our years to now 27, and technically with whatever's left, but just for simplicity's sake, I'm just going to assume that it's still 30. And then in that case, your payments would then become 536.82, right, which is significantly more. Right, so this is one of the things that you would have to weigh when you're deciding between a fixed rate mortgage and an adjustable rate mortgage. But that concludes this video on loan payments, credit cards, and mortgages. I hope you enjoyed, and I'll see you next time.